The saying, "nothing comes for free," is perfectly suitable for the situation around mutual funds. Every company charges its customers in exchange for the items or services it offers, and the expense ratio works in the same way. Even if some of you might know about the several benefits of mutual funds and how worthy it is of your time and money, one shouldn't skip on knowing about the expense ratio, something which works as the brokerage rate. Confused? Let's get into it. What exactly is the expense ratio? Simply put, the expense ratio is the annual fee that mutual funds charge their shareholders. It covers the fund's operating expenses and is expressed as a percentage of the fund's average assets under management. The expense ratio includes various costs such as management fees, administrative costs, and other operational expenses. Let's break it down. 1. Management fees. This is the fee paid to the fund managers who make investment decisions. 2. Administrative costs. These are the day-to-day expenses of running the fund, like record keeping and customer service. 3. Other expenses. This can include marketing and distribution fees. If the fund's assets are small, then the expense ratio will be high. This can be the case if the fund meets its expenses from a restricted or a smaller quality base. Similarly, if net assets of the fund are vital, then the expense share ought to ideally come back down. On the 18th of September, 2018, SEBI, Stock Exchange Board of India, caused important modifications by reducing the TER, total expense ratio, of mutual funds and ever-changing the strategy of providing a commission to the distributors. Let's look at an example. Suppose a mutual fund has Rs 100 million in assets and the total annual expenses are Rs 1 million. The expense ratio would be calculated as expense ratio equals total annual expenses divided by total assets equals 1 million rupees divided by 100 million rupees is equal to 0.01% or 1%. So, the expense ratio for this fund is 1%. Why is the expense ratio important? Here are a few reasons. 1. Impact on returns. A higher expense ratio can eat into your returns. For example, if a fund returns 10% annually but has an expense ratio of 2%, your net return is only 8%. 2. Comparison tool. It helps compare the cost-effectiveness of different mutual funds. Lower expense ratios are often preferred as they leave more of the returns for the investor. 3. Transparency. It provides transparency about the costs involved in managing the fund. Expense ratios vary between actively managed and passively managed funds. Actively managed funds, where managers make frequent investment decisions, typically have higher expense ratios. Passively managed funds, like index funds, generally have lower expense ratios since they track a market index and require less management. To wrap up, the expense ratio is a crucial factor to consider when choosing mutual funds. Remember these tips. 1. Compare expense ratios of similar funds. 2. Consider the impact on your long-term returns. 3. Don't sacrifice fund performance solely for a lower expense ratio. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe for more financial tips. Leave your questions in the comments below, and we'll see you in the next video. Happy investing, everyone!